Streamer joining us here at Post 9 this morning. Oppenheimer's Jason Helfstein has a buy on the stock, 75 target. It's great to see you back. Just explain, what do you think the catalyst was here? Is it about the ad tier craze or something else?
Yeah, so I think this stock was one of the favorite shorts, and so we're definitely seeing more short covering, positioning more offensive into potentially a Fed, easing, call it flattening and then easing cycle. And so I would say the move in the stock isn't particularly fundamental. It's been more technical, but we think the setup is very good from a fundamental standpoint.
So how long do you stick with it? I mean, talk to me about...
Oh, no, well, you're just at the beginning. So Roku was basically an early cyclical. So they were one of the first to get hit when advertising slowed down. So therefore, they should be one of the first to benefit when advertising rebounds. In addition, we've seen very stable active account growth. Active accounts up 17% in the first quarter. Streaming hours up 20%. So, to the extent that there's been a concern of a COVID hangover, we're really not seeing it in this company. And, the ad market is going to get better. It's just a matter of time.
I'm trying to remember how early they were in sort of adopting operating leverage discipline, right? Cost discipline. I know Anthony would come on all the time and talk about how they were agnostic about original content, but then that theme kind of got muddied a bit. Where are they on that front?
So they cut back, and then when they actually saw kind of like the COVID pull forward, they leaned in, but then they leaned in too hard, and then they cut back again. So we've changed our kind of timing for EBITDA profitability multiple times. At this point, we're thinking break even next year, meaningful profitability in 2025. If you look at the stock on kind of gross profit, because you can't do EBITDA yet, it's basically trading at a bit under 5 times gross profit next year. Meanwhile, Netflix is 13 times. Another ad tech company, Magnite, is 6 times, right? So, we think that this is a stock that used to be $4.50 and is now $75, or $75. So we think it's super early. They have a third of households for connected TV, we think, kind of globally. And really, there's just no competitive threat. There's really a cyclical play at this point and execution. And they have a new executive that we're very bullish on.
But isn't a cyclical play challenging in this moment? The ad market hasn't rebounded.
It hasn't, but it's not getting worse. And our bet is as the Fed potentially stops raising and ultimately eases, you're going to see advertising recover, potentially in the fourth quarter, but most likely in the first half of next year.
You cite a multiple for Netflix, for example, but it actually generates free cash flow.
True.
I mean, when are these guys going to do that, and how are you discounting that back to get to what you feel, I guess, is a good multiple to be buying at?
Sure. So we're looking for basically break even next year. I mean, the multiple, we're putting a multiple on 2026, so kind of 20 times that year's cash flow, so you do have to go out. This is a model that has tremendous leverage. I mean, they could go from break even to $200 million literally of cash flow in a year. So, hard to know the timing, could be off by, 6 months, et cetera. But the bottom line is, the threat of Google smart TVs, the threat of Amazon smart TVs, it's just not happening. It's really between them and basically Samsung, and then kind of every other operating system just doesn't have scale in the game right now.